Wednesday, April the 1st, April Fool's Day. I wish it was. Look, here we are. We've just finished the worst month that the Dow Jones has ever had in its entire history in the month of March 2020. It has been an absolutely volatile and, generally speaking, downward ride when it comes to equity markets, when it comes to fixed income. While things have seemed to have settled out at this point, we're seeing a few events occurring that I think is worth noting. One, we are seeing Treasury yields continue to get compressed, especially on the risk-free rates, both in the United States and Canada. Reminder, a risk-free rate, and there's only one security that can be defined as being risk-free, and that is Treasury bills. I continue to maintain very serious conviction for our fixed income, short-term institutional cash investors. You need to have some money in Treasury bills. Canadian Treasury bills right now are yielding effectively at zero. The market rates are maybe a little bit above zero, but once you take in bond desk fees and commissions, it's basically paying clients net to client rates of zero interest rates. It could go negative. It probably will go negative. In the US market, we are now into a negative yield territory on US Treasuries. I've been talking about this for a while. Right now is not the time to necessarily be chasing yield. We are recommending clients take 10 to 20% of their portfolio and invest it in something that they can know provides them with a peace of mind in a much worse scenario than we are in today. As of right now, there is, based on the Johns Hopkins website that's tracking the COVID-19 crisis, we're just short of 1 million cases of COVID-19 globally, and we are seeing the death rates are now starting to rise, with a caution by many different authorities that we could be, in the United States at least, up into 100 to 200,000 deaths over the coming weeks. This is why I am so adamant that clients need to focus on capital preservation first, liquidity second, and yield third. And one of the questions I often get asked is, do I think the banks and credit unions are going to be, if they're not going to be able to fulfill their obligations to provide investors with their funds back at maturity or on demand? I don't believe we're there. I mean, we may not get there. Fortunately, we had a very recent test in 2008, 2009 with the global financial crisis. The balance sheets of these banking institutions are much stronger than they were back then, but this is something very different and very new. And I don't know, neither do you, nobody knows. So it's prudent in an environment like this of unknown chartered territory to take a conservative approach. You can chase yield later. Now, I am recommending, and we are recommending, our clients take 10 to 20% of their portfolio, put it into a Treasury bill, rolling 3-month Treasury bill program where you're basically getting zero on your money. But you can also still get a decent yield on the other 80 to 90%. The approach with that means you need to focus on creditworthiness and diversification. It's a really simple model. Now is not the time to get fancy, but there are some pockets of opportunity. We are seeing a lot of change happening virtually on a daily basis. We're no longer sending out regular rate sheets because we'll notice that one week TD Bank's into the market pricing very aggressively, and the next week it's Royal, and the week after that it's another banking institution. These banks, many of them, are the feedback we've been getting from the banks and credit unions is that they're trying to pump up their balance sheets right now in the event that there's a further drawdown on their deposits. You can take advantage of this, but do it with proper, prudent investment management strategies of diversification and keeping yourself liquid. On the equity side, we could get into a much worse situation than we're in today. Think about this. We're only over 4,000 deaths from COVID-19 in the United States today. If the US authorities, of the US administration, the government, who are saying that there's a realistic possibility of having between 100 to 200,000 deaths in the United States, think about the impact that will have psychologically on investors. If we go into a period of sustained quarantine and isolation with pubs and restaurants, retail stores and recreational facilities and schools being closed for months, this is going to have a serious financial impact and will really test the capacity for the central bank and federal and state and provincial governments to carry us through this COVID-19 crisis. We could see equity prices go way lower. I believe there's value in putting some capital to work today with some great names out there, but make sure that you are in a situation where you still have some liquidity. You still have some, as we say in our industry, keeping some of your powder dry, because this could get much worse. Make sure you have a proper plan in place. If you want to speak to our team, we've got a dividend investment portfolio that we think makes a lot of sense. It's focusing on Canada's largest, most profitable and well-capitalized companies, currently paying a dividend yield of over 6.5%. Seems like whenever you turn on the news, it's a very scary time right now. There's a lot of negative events happening. Be sure with yourself, be sure with your portfolio, invest only what the money that you feel you are willing to risk. Take your time. Don't chase yields if you're a fixed income investor. If you're an equity investor, don't go all in all at once, because you don't know how much worse this can get. Neither do I. Good luck, and we'll report back to you soon.